this is a Picasso. On the planet, there's probably one person who's willing to pay $220 million for this Picasso. There's probably more than one person, let's say two, who are willing to pay $100 million. More are willing to pay $80 million. There's quite a lot of people who would pay $10 million for that painting. And if that painting were to show up at an estate sale in your neighborhood, there's a whole lot of people who would be willing to spend $1,000 on it. Now, because there's only one of them, when this painting went to auction, you basically can take all of the economic factors of the time, the liquidity, how fluid the economy is, how comfortable people are, and you'll arrive at a price that is between the values with which the multiples at the high end here are willing to pay. So the actual price it sold for was $139.4 million. Now, what if that painting had identical copies that were all original Picassos? Well, in this particular case, let's say you had 6 of them come up for sale, the price would fall considerably because you'd have to the people who are willing to pay the higher prices would get taken out, and then eventually it would settle at some other price. And essentially this is what the stock market is. You have a limited number of shares that are available, and then you have a whole bunch of people who calculate how much they're willing to spend for the shares, and then the price reaches some equilibrium between the number of shares available versus the price people are willing to pay. That is what the channel is, which is the yellow line on this graph here. It is the value with which the mass of people would be willing to pay. So for a stock like Tesla, which is much higher than the current channel, you're dealing with very limited numbers of people who are willing to pay these prices. Whereas if Tesla was much lower, a much larger percentage of people would be able to pay. Now, if Tesla's price were to fall, let's say it were to fall all the way down to $30, then a whole lot of people would buy the stock. So when you're dealing with stocks, you have various share count numbers. You have the total authorized share count, which is the legal maximum number of shares that a company can issue. And then you have the outstanding share number, and that is the number of shares that are currently have been issued and are registered. But under that, you have a hidden variable, which is the effective float. So out of the outstanding share count, a percentage of those shares are held by insiders. These are people who are not regularly going to sell, or institutions. These are large investment firms that have longer time horizons than in weeks or months. Like, these are people who are going to hold for years. But even below that, you have family offices, which don't have to always file, or so you don't know what positions they have. Then you have retail investors who are going to hold the stock for a longer period of time. So there is some value of shares that is for sale at any given moment in time, and there's some number of shares that is not for sale at any given moment in time. Now, the float that you see reported online just ignores the institutions and the insiders, but the float values that are on completely discount all of the other people who could have taken shares off the market. So finding the absolute value for what the effective float is very, very difficult unless you can monitor all brokerage accounts everywhere. But what you can do is you can monitor the condition when the effective float changes. Like, for example, if all of a sudden there's a large increase in the effective float, more shares come available for sale, then the market behavior is going to change. When you toggle between these two states, what happens is that the algorithms will get used to making profit on scalping in a certain condition. Now, the algorithms don't know when the effective float has changed in a real-time basis, unless the market maker who's making that algorithm is the one that's changing the float. So, for example, if you want to sell 1,000 shares at $10. What happens is that the market maker will attempt to sell 1,000 shares at $10 and let's say a penny, right? And as soon as they complete that sale, they will then take your shares off from you, so that they'll have made a penny on that sale per share, and you have sold the shares that you want. Now, the algorithms will base the spread, which is what they set the bid and ask to be, so that they can make a little bit of a scalp off of every trade they make. So at the end of the day, they are ideally not holding shares and they've made profit. Now, if an algorithm notices that it's not able to make profit, or at the end of the day it's holding shares or it's net short a position, it's going to change the bid-ask spread in order to try to compensate for that. So we have code that monitors this to determine when this has happened, when an effective float change has happened. Okay? And that is this little purple line that we put on the volume graph. Okay? So at this moment in time, what appears to have happened is that the effective float changed. In this particular case, it looked like it decreased. And what happens after a decrease in effective float is the stock price generally moves up because the bid-ask spread changes. Okay? The bid pressure is usually consistent and the ask pressure is usually consistent. But if you are competing over fewer shares on the market, you're going to get a price move. So that is how to read a chart, and that is the logic behind both the channel and our liquidity indicator. The rest of the chart is pretty simple. We put on the top right corner these little stoplight graphs. This is the relative health per quarter of both short-term and long-term liabilities. And there's nothing for Tesla here, but we put the vertical bars, which are upcoming events, which are color-coded based on historical data of similar events.